Hello, everyone. Today on the final bar, my guest is Jason Goepfert from Sentimentrader in Minneapolis. We're going to talk about some signs of euphoria, perhaps. I'll let him fill in the blanks in terms of what we're seeing, the speculative nature of the markets right now. Overall, looking at stocks, it's a market in transition. Earlier in the day, you had the Nasdaq up, you had the Dow down, you had the S&P in the middle, sort of a flip upside down, of what a lot of days have been. But you're still seeing plenty of signs of potential weakness. The Nasdaq actually finished flat for the day. Small caps down pretty big though, as energy and others sold off. Let's get to all of that and more, ladies and gentlemen. This is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com, coming at you from on location in Eastern Washington, enjoying the view, also enjoying a deep dive into market activity. And today it's really talking about rotation. We've talked about this theme of leadership rotation, growth versus value, stocks versus bonds, all these different things, moving parts and trying to make sense of them. Today it felt like a great sort of example day for what this market has felt like. You had earlier in the day, it was this big sort of differentiation or dispersion between the winners and the losers, stocks that were working and stocks that were not. But overall, sort of settling in more negative than positive is how I would describe it. If you look at what's at the top of the list, it's things like communication services and tech. But the stuff that's gotten us here in the last, couple months, really since last fall, since the fourth quarter, really lagged today. And so that's weighing on the overall market environment, certainly weighing on some of the risk on measures that we've been looking at in terms of small caps and elsewhere. Now we have great guests on the final bar. It's one of the best parts of the show, or the viewpoints that we can bring in. Today we have Jason Goepfert from Sentimentrader. I've followed Jason's work for years and have always found his insights, long-term insights on investor sentiment have been fantastic. Tomorrow on the 17th, we have Craig Johnson from Piper Sandler. On Thursday, Tony Dwyer from Canaccord Genuity and Dwyer Strategy. Coming up next week, we have Mark Newton from Newton Advisors. And just this coming Monday on March 22nd, Chart Madness. This is our March Madness themed stock picking exercise. Yesterday, I spoke with Tom Boley, Greg Schnell, and Grayson Rose. We compared notes. We are all preparing our brackets very soon. We will have a page ready for you on our website. You can go download the bracket with 16 stocks, fill in your own in terms of what you see as the best opportunities over the next 6 months or so. We'll be on the video on Monday, the 22nd, debating the strengths and weaknesses and coming up with our own final fours. That's on March 22nd, called Chart Madness. No poll today. We did have a poll running over the weekend. Asked you for ideas for what guests we should have on the show. As always, we'd love to hear ideas from you. Shoot us an email, thefinalbar@stockcharts.com. If there's anyone that you read or watch or follow and think it would be think they'd be a good guest on Stock Charts TV, please let us know. Let's continue with our market recap. As I mentioned, this is really a market in transition. If we had big flashy graphics during the day, that might be sort of the ongoing background graphic I would advocate for right about now. From a short-term perspective, you're seeing a lot of movement, a lot of mean reversion. I think that's right. A day like today, you have communication services and technology up 1% and 0.8%. You have things like industrials and energy down 1 to 3%. So that's contrary to what we've seen leading up to this week for the most part, right? Sort of a mean reversion. But overall, I think there are plenty of question marks that are still there in terms of the potential for meaningfully higher moves from here. I've gotten some questions and pushback in terms of, in general, having sort of a bearish, cautious look to things, but then recently pointing out things like breadth that has been very positive. And so let me tell you, there are a couple things to think about. Number one, there's the time frame issue, right? Are we looking short term at swings, or are we looking long term at structural changes? I think structurally, I don't think my opinion or my anticipation for this year has changed, which is a choppy 2010 like year. That was a similar year after we came out of a very bombed out level. We had a very choppy sort of transition year made new lows a couple times, new swing lows, but in the end finished positive. And I wouldn't be surprised we have a very similar feel to this year. I think people get caught off guard as we make new highs. I think people will get caught off guard as we make new lows and expect that trend to continue. This feels more like a choppy transition year. But also I think it's in terms of the trend and the leading indicators and the lagging indicators. For me, the lagging indicators are, for the most part, very positive. Things like the cumulative advanced decline lines all making new highs. Just the chart of the S&P itself, on a day when it's making a new all-time high, you should not be that bearish, in my opinion. You should understand that the price is going higher, and until that stops happening, I would want to be leaning into stocks overall. Having said that, though, the leading indicators for me, which are the things that anticipate turns, the things that identify trend exhaustion, when buyers have gotten too aggressive, when signs of euphoria are rampant, when people have pushed prices higher than their reasonable valuations, that's what suggests to me not that the timing is perfect for a turn, but overall I'm looking for signs of a turn lower because I'm getting indications that the upside is limited. And just the chart of the S&P shows you that. Every new high we've made for the last 2.5 to 3 months, we've seen lesser and lesser momentum. So every time the price has gone higher, the RSI has actually made a lower high. That is not the sign of a sustained move from here. That's a sign of a trend in exhaustion. Now, the challenge, of course, to this thesis, and the reason why I say this is not the sign to be completely out of equities, because that divergence started back here in January, right? You saw higher highs in price. You saw lower peaks in the momentum. It was overbought there the first week in January. Third week made new highs on lower momentum. That's when we started talking about divergences. This is when things like semiconductors and others going into February showed clear divergences. We've now had a continued pattern of higher prices and lower momentum. In my experience, that tends to resolve lower. But again, this can take months for a top to sort of play out. And I would argue, given the transition we've seen and given the signs of euphoria that I've seen with sentiment, I think we're still in that transition period. And again, for me, it just means an increased likelihood of lower prices from here. There is always a possibility that you go higher. And in general, what's encouraging about where we're at is you are finding stocks that continue to go higher. And that's what has been, I think, a saving grace to this sort of transition environment. There have been stocks that have been going up with no problem at all, with minimal pause in their trends. Let's see what else we can tease out looking at the different markets of interest. 10-year yields back higher today, with the 10-year yield going around 162. The TLT was down about 0.4%, and the dollar essentially flat around 24.75 today on the UUP. Gold prices actually finished positive. It was a very choppy session for most commodities. Overall, sort of flat to down here. And energy prices coming off. This is why the energy sector, the weakest of the bunch. Cryptocurrencies, volatile as usual, but finished overall net positive, with Bitcoin up about 1% from where it was yesterday, back above 56,000. So, overall, what is the way to think about this? Things that I would be looking at, the small cap index, right? So, today you saw small caps come off a little bit. I would remind everyone that is coming off of, 52-week and all-time closing highs for the last 3 sessions. So this is not by any means the end of the world. But again, what concerns me on the chart of small caps, as with many charts I'm looking at, higher highs in price, negative divergences. Again, the challenge is we've had some of these divergences in previous months. They have not really resolved lower yet. But again, for me, when I'm thinking about risk reward, this tells me the upside reward is limited. The downside risk is increasing or is significant. And that's what causes me to certainly be more cautious than the trends may imply. Other things to pay attention to: consumer staples actually number 3, followed by utilities. Actually, they're jumping around a little bit as we're processing the closing prices, but both up, just a little bit above zero. So, again, yesterday you had utilities lead on an up day. Now you have utilities in the top 3 sectors on sort of a flat to down day. So you've actually seen utilities come up and bubble up to the top a couple times here, which is always sort of an interesting pattern. If you're optimistic about the markets, you probably would not be thrilled to see utilities making new highs, but I would as always caution you on making conclusions like that. Don't look at something like utilities working and think that means the market may be in trouble. If utilities start outperforming, what does that mean for stocks? If people are getting defensive, There have been years like 2014 where the top two sectors were utilities and real estate. That was in an up year for the S&P 500. So, in general, I don't think, should sort of investing, don't should have invest, which is say, this market is doing this, so that means XYZ should happen. Focus on what actually is happening. Lean into the sectors and themes that are working. In the month of March, the first couple weeks here, you've seen utilities now start to turn higher on a relative basis, but that's after a year of being in a significant, consistent relative downtrend. So I still think there's, I would question the upside in this. Now, if the XLU gets above 64, if the RSI gets above 60, if the relative strength continues to go higher, that tells me to start to think a little more deeply about the upside potential for utilities. But at this point, it's more cautionary than anything. I'll switch back and finish with the Mindful Investor Live chart list and just hit on a chart or two before we take our break. Again, what causes me to just feel like we want to hold on and wait for signs of anything different? The fact that the cumulative advanced decline lines look like this. I published a chart on Friday in our Chart Watchers newsletter. I posted it today on the Mindful Investor blog post on StockCharts.com, basically saying this is the chart you need to stay bullish. And what I mean by that is, if you're bullish, you want these charts to continue to go higher. One of them is the cumulative advanced decline lines on the on these four, particularly the NYSE, because this has more of a small mid cap sort of feel to it. So when this line continues to make new long-term highs, new all-time highs, especially new, at the very least new 52-week highs, tells you not to be too nervous, because once that stops happening, that's when you can recognize that stocks as a whole, on average, are starting to roll over. We have not seen that yet, so the trend remains positive. We need to take a quick commercial break. Back with my guest, Jason Goepfert. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close for our show as we break down the market's activity using the lens of technical analysis. As a reminder, we would love to hear from you. We're going to do a mailbag segment a little later in today's show. We'd love to answer one of your questions in our next mailbag segment on Friday's show. Shoot us an email, thefinalbar@stockcharts.com, with any questions that come up in your own process. You can also tag us on Twitter at FinalBarSCTV, or on our YouTube channel. Just put a comment below the video that you're watching. We'd love to answer one of your questions in our next mailbag segment on Friday. Also, as a reminder, the new StockCharts TV on-demand app is out and ready. Go to StockChartsTV.com, set up a free account just with your email, and you can start watching all of our great content from all of our great hosts. Also, on all of the app stores, just search for StockCharts TV on demand, and you'll find us there. I want to welcome on my guest to the show, Jason Goepfert. Jason's the president of Sentimentrader, coming to us from the Minneapolis area. Got to sit down with Jason not too long ago for our second season of Behind the Charts. And Jason, it was such a pleasure to learn more about your background and sort of bring some of those stories out. And it's a pleasure to have you on the show today.
Well, thanks, Dave. I appreciate it.
So when I think of you, Jason, I've followed your work and what you've done for many years, and I've enjoyed, as always, your perspective on investor sentiment. When I want to know what investors are thinking, I tend to look you up and see where you're at. You have a couple charts that are showing us what you see as the conditions right now. Take it away. We have chart number one up.
Well, yeah, I mean, we've all heard the anecdotes about, where sentiment is at the moment with the proverbial shoe shine boy type thing. And we just try and quantify this as much as possible. And one of the best ways is through put call ratios. One of the weaknesses with traditional put call ratios, though, is that we don't really know who is doing what. We don't know what size of trader. We don't know what strategies they're doing. So what I like about this data is it gets us much more into that vein where we actually do know, for the most part, who, and we know for the most part what they're doing. And so this is looking at only retail traders. So this is 50 contracts or less, and this is only buying to open transactions. And typically, there could be some stuff mixed in there with some institutions breaking up orders into smaller parts. I think that's a very low risk. There is some skew with ETFs, but this is about 85% equities only. So to me, it's the most accurate measure we can look at for the options market. And so this is expressed as a percentage of US market capitalization. So we're only looking at the premiums spent. So we're looking at actual monetary outlays for bullish minus bearish strategies. And over the past week, it's dropped a bit over the past couple of weeks as stocks have pulled back, but it's still about 0.015%, which doesn't sound like a whole lot when you scale it that way, but that also ignores some of the knock-on effects. An option controls 100 shares of stock. So when you normalize things that way, or just look at it this way as a percentage of market capitalization, you can just see how extreme it is. And last September was that first egregious spike towards 0.03%. And then a couple weeks ago, a few weeks ago from here, that's when we hit the record high in speculative activity. And even though it's dropped off quite a bit in the past couple of weeks, it's still above every other extreme. There was that spike in 2000, it's above that. There was that spike in 2007, it's above that. 2012, the market didn't do much there, but the S&P still pulled back about 10% following that spike. And then again, the latest one in early January of 2020 was the other one. And then, since then, whether this is the stimulus checks or whatever it is, there really can be no question from this measure that we're just seeing this tremendous spike in speculative activity.
Certainly increased speculation, and particularly we're looking at options here, which is obviously where we've heard a lot of individual investors sort of nibbling at the options market for the first time, and I think that chart seems to speak to that. Now, chart number 2 is looking at particular types of names that people are looking at. Talk us through this one.
Well, yeah, and like you said, the options market is one of the most leveraged speculative areas of the market that you can get to, and the other one is penny stocks. I grew up the 1990s, my investing adolescence, and when they were called pink sheets, over-the-counter stocks. So this is really any stock that doesn't meet the requirements for a major listing on the NYSE or NASDAQ. Typically, they're listed for under $1, not necessarily, but it's not like there's just a few stocks. There's thousands of stocks on these exchanges, and typically it's kind of a backwater in the investing space. It doesn't really get that much attention. Starting in December, that started to change. Again, whether that's stimulus money, whatever it is. January it picked up again, and then in February it spiked yet again. And so this is the total dollar volume of transactions in the over-the-counter market. And so in February, it was about $85 billion, which is a pretty significant figure. And the only time dating back to 1995 where that was exceeded was January, February, and March of 2000. And it was more than double what we're seeing today. But again, it's the type of activity that we're seeing, and especially relative to the past decade or even 15 years. And some of this stuff is it's off the charts almost.
These are fascinating charts, and I love the long-term view that we're looking at, Jason, and showing how right now fits into the big picture. We only have about a minute left, but I'd love to ask you, just to put it simply, how does this end, right? When you see this sort of speculation on 2 measures, how does this sort of thing resolve? Are there certain things that you would be looking for, a change in behavior, a change in market activity? But it certainly seems like this sort of speculation is unsustainable. So what do we see next? How does this continue?
Typically, it's either a blow off where, like in 1999, 2000, where it was just these gigantic gaps up in a lot of stocks, $50, $100 gapping up in the morning, where it's just this, where you just have this sense when you open your monitor, it's like, this is insane and it can't continue. And typically it doesn't. Typically that's about the end of it. Or it's just, where these guys finally start to experience losses and step away. And whether that's, it's so easy to put anecdotes to this and assign a narrative to it. But as they go back to work and they start to lose money in some of these accounts, they'll probably just step away. And, that's going to be a big leg of this last leg up that's no longer there.
It certainly seems to be a theme you and I and many others will have to be dealing with through the rest of the year, if not beyond. Jason, It's so good to have you on the show. I really appreciate your perspective and sharing some of your views on what you're seeing. Stay safe, be well, and we'll talk to you again soon.
Thanks, Dave. You too.
That's Jason Goepfert. Jason's the president of Sentimentrader, coming to us from the Minneapolis area. And it's funny when guys like Jason and I'm thinking of some of the other conversations I've had with Ari Wald, with Jonathan Krinsky, with many others over recent weeks. You see the long-term perspective that they bring, and I think that's, if there's any lesson I am learning from having conversations with some of these guys and ladies and ladies as well over the weeks and months, it's to remember that people that are doing this over the long term and have found success are taking a very long-term view, and they're seeing how the short-term movements of today are fitting into a much longer-term thesis, and making sure that that is where long-term decisions are made. I wrote earlier, I think one of the biggest mistakes or biggest fouls that you can call on yourself as an investor is making long-term decisions on short-term data. And hopefully some of these conversations help illuminate the value of some of these long-term plays. We need to continue on and go to the final bar mailbag, answering some of your questions that we've received recently. Let's get right to it. Question number one, the XLE has had an extremely high correlation with USO over the past 6 months. Does one lead the other, or are they reciprocal? What drives prices for oil as a commodity? In short, any advice for making trading decisions in the energy sector based on oil prices? So yeah, so you're absolutely right. When you think of, and I know just from being at a shop where we were pure stock pickers, if you wanted to understand the energy sector, you basically needed to know this chart and get it right. You need to be on the right side of oil prices, because for the most part, the energy sector, the XLE, is going to be driven by oil prices. Is there a leading in, from one to the other? I don't think. I think in general, the higher oil prices are what are most important to pay attention to. So I would think that leads everything. So if you ever read on where oil prices are headed, that's such a driver on energy companies. Now, within the energy sector, you have to remember that pretty much two stocks, ExxonMobil and Chevron. Exxon and Chevron are a huge weight. Those two on their own, big integrated stocks, are a big weight in the XLE, and then it's kind of everything else from there, all the exploration and production, the refiners, and the other integrateds and everything. So, really, there are times when those will move different. Exxon will move different than the other energy stocks. But if you're thinking of the XLE, that's pretty much what I would be looking at. And it's about commodity prices, in particular, this specific chart. This is $ WTIC. And I would point out, remember, when you look at the USO, the problem with that is if you look at a longer term, it gets more and more disconnected from crude oil prices, because it's based on the commodity. There's a rollover effect and other things. So if you're looking more than a couple days, I would be looking at this $ WTIC, because that's the actual trend on the crude oil future to pay attention to. Chart number two, or question number two, really like the divergence example of SMH versus SPY using RSI. That was from last week, if I remember right. I think I found one better, ARK, ARKK, on the daily in January. You're absolutely right. Does the law of syllogism apply in ratio analysis? I love that word. If ARK is weaker than SPY and SPY is weaker than SMH, then is it true that ARK is weaker than SMH without having to chart it directly? So I did make a chart just to show what you were trying to ask, and the answer is yes. So if stock A outperforms stock B using relative basis, and then stock B outperforms stock C, stock A does in fact outperform stock C. You don't need to chart that, because it's a simple ratio and the direction will be in line. So here we're looking at ARK underperforming semiconductors underperforming the S&P, therefore ARK underperforming the S&P. That's exactly what how it should work, and that's exactly what it does. So it's interesting. What's basically happening here is ARK is down the most out of all of these, essentially, right? And that makes sense. It's more of a beta thing than anything. ARK is higher risk, it's higher volatility, it's higher beta, which means if the market's down, ARK is going to underperform. On an up market, ARK is most likely going to outperform, depending on the leadership. And that's one of the challenges that ARK is facing. It's obviously very narrow into technology, clean energy, those sorts of things. If that trade doesn't work, the ETF is going to struggle. And that's kind of what we've seen recently. Next question. I don't understand $IRX and how to read this chart. This is the chart that you shared with me. Does this have to do with the yield curve? Why is there zero volume? Thank you. Yeah, so the quick version of this, you're actually looking at an index. $IRX is the 3-month point on the Treasury curve. So the Treasury curve goes from 3 months, 1 month, 3 month down at the very, very left low end, all the way out to 20, 30-year debt. And so these are the different types of notes and bonds that that the government issues. And so it goes from maturity, the short end to the long end is what you say. So you're looking at the short end of the curve when you're looking at 3 months yields. This is not as a tradable security, although there are ETFs that try to match the short end of the curve. But this is basically just an index tracking the yield on treasury bonds. So it's basically an inverse of bond prices on this short end. So that's why there's zero volume. It does tell you this. What I often look at is the 2-year point minus the 10-year point. Other people look at this point, the 3-month point minus the 10-year point, and that is just giving you a line which shows you the shape of the yield curve. And as we've talked about, steepening curve tends to be better for banks, especially regional banks. So higher yields, especially a steeper curve, which means the long end is getting higher than the shorter end, and that is increasing the difference between the two. That's basically how a bank makes money, and so that's why it's going to do better. By the way, if you want to know more about those, go to the market dashboard, the market summary page. That has tickers for all the different points in the yield curve and also ETFs you can follow. Let's see. I posted something about advanced decline lines, and someone asked, would the Russell 2000 have to underperform to get negative divergence between those AD lines and the S&P 500? So, technically no, but kind of yes is how I would probably answer that. This is the chart you were looking at it. So you're saying, would the Russell 2000 need to underperform? So here is the S&P small cap advanced decline. That's really looking at the S&P 600, but same idea. It's a similar universe. It's just 600 instead of 2000 stocks, but small cap names. And so this is looking at an equal weighted version. How many of those stocks are closing higher or lower on the day? So it's not that the Russell 2000 index would have to underperform. It's that more stocks would be closing lower than higher on a sequence of days that would make that line go down. Now, in general, that tends to be pretty similar because when the stocks that make up the index are going down, the index itself tends to be going down. And that's why we look at this chart, because if the market's going higher and the advanced decline lines are not going higher, that tells you there are less and less larger stocks that are propelling the index higher, even though a lot of names are already rolling over. And so that's why that is an important one. That's all the time we have for questions. Boy, I love going through these questions. We have others that we will get to later in the week. I'd encourage you to keep them coming, and we'll do our best to answer your question on the air next time. We need to wrap the show. Go to the 3 and 3, 3 charts, 3 minutes. Here we go. Hold on. I don't have the right charts up. Let's go through this one. Chart number 1 is looking at the cumulative advanced decline lines. We finished here. The last question we had was talking about divergences. And again, what's great about this chart is it focuses on the message of the markets. It focuses on not just the broad indexes, but it focuses on the stocks that make up those indexes. And so when you see the indexes going higher, that's great. When you see these lines stop going higher, that's what it tells me to be concerned, because it tells you individual stocks are starting to struggle. And that tells you that there's potentially some concern with further upside potential. Chart number 2 is crude oil, WTIC, $WTIC. Again, a lot of people use the USO for oil prices, which is totally fine day to day. And that's why I use that. It's a very liquid ETF. It gives you a good track of oil prices during the day. That's what we show on our market dashboard, on your dashboard page. However, the real way to look at it over the long term is $WTIC. And you can see how this has eclipsed its highs from mid to late 2019. I have this line showing the September 2019 peak, the January 2020 peak, and you can see we've just eclipsed this. Contracts, when you look at futures contracts over a long period of time, commodities, there's some weird things that happen because you basically have to roll over, and we're looking at a continuous contract, which means you have to sort of do this artificial thing to smooth over the price movements over time. So, if you look at this chart on different platforms, you might get a different read the further to the left you go, because the data is actually changeable depending on how you want to smooth out the data. By the way that we tend to smooth it, it's showing you new highs. What concerns me about oil and about energy stocks, I've talked with Greg Schnell, who's pretty positive on energy, but what concerns me is the fact that we have oil prices going higher. We have the momentum on oil prices going lower. And for me, that is certainly a bit of a concern. The final chart, we had a question on interest rates, and I want to bring up the chart of the 10-year yield. You asked about the 3-month yield. The 10-year yield is the more commonly used item, similar to where we have a bearish divergence in oil prices. You also have a bearish divergence in the 10-year yield. And so what this tells me is days like this, we have energy financials underperforming. I think there could be a little bit more of that as maybe the growth trade bounces up a little bit. You have things like financials and energy that have had good runs. Interest rates maybe come off a little bit, maybe more than they have before we see a continuation of those long-term trends. And I would assume that that's where we're going to continue until proven otherwise. Folks, that is our show for today. Thanks so much for joining us every weekday for the Final Bar. Special thanks to Jason Goepfert from Sentimentrader joining us and sharing his thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.